Hello, fellow investors. Mike with DividendGrowthInvest.com, and today we're looking at consumer staples. As of April 2018, the consumer staples sector has been absolutely devastated. When I refer to consumer staples, I'm discussing essential products like food, beverages, tobacco, and household items. Some of these companies recently experienced their worst one-day drops since 2008. So, with the economy in presumably strong condition, why is this the case? Should we worry? Well, in the short term, I don't expect things to get much better, and we'll go into those reasons shortly. But long term, I'm not too worried and still plan on averaging into the market slowly. Now, consumer staples are down big for several reasons. First of all, consumers, especially millennials, are demanding healthier, natural, and socially responsible products. Essentially, all these companies are grappling with rapidly changing consumer preferences, and this seems to be accelerating as millennials gain more and more purchasing power. In response, beverage companies like Coca-Cola launched products like Coke Life, sweetened with stevia and cane sugar. Hormel recently acquired natural, high-end brands like Justin's Nut Butter and organic Applegate Meats. And just a few weeks ago, General Mills announced an acquisition of Blue Buffalo Pet Health Foods. Many companies in this sector are over a century old and have had to deal with these changing preferences before. It will take time, but eventually these companies should be able to reposition themselves. And we're already beginning to see some success among many of these companies as organic growth is beginning to tick upwards and sales are finally starting to increase. A second reason for these price declines is rising interest rates. The Federal Reserve is projected to increase the federal funds rate 3 to 4 times this year. Also, the 10-year Treasury recently hit 3%, a rate not seen since 2014. So as interest rates rise, so does the cost of capital. Therefore, borrowing money to fund new projects will become more costly for businesses and thus weigh on earnings. That being said, higher interest rates typically signal a strong economy. The fear is, however, if rates go too high, there will be a recession. And third, these high rates make consumer stocks and pretty much all dividend stocks less attractive. If interest rates rise enough, investors can simply invest in bonds, earn a decent rate of return on these bonds, and take on far less risk. Remember, in times of crisis, debt holders or bondholders get paid before the shareholders. So essentially, you have higher interest rates, potentially slowing the economy, and two, bonds offering comparable rates of returns to that of dividend stocks. And finally, we're seeing higher expenses among many of these companies and thus lower margins. Some of this has to do with interest rates, yes, but the economy is also strengthening. With higher demand comes higher prices. You can see this with the price of oil. As oil prices rise, gasoline prices also rise. Thus, transportation costs increase and weigh on earnings across the board. Furthermore, companies are spending heavily on marketing and advertising as they roll out their many new products. So there are some causes for concern, but bear in mind, most of this is fairly normal. We go through periods of high interest rates and low interest rates. Expenses go up, they go down, and companies make adjustments accordingly. Perhaps more encouraging, however, is how these companies like Coca-Cola, Procter & Gamble, and General Mills are finally starting to see organic sales growth after years of stagnation. This means consumer companies seem to be working through the main problem of changing consumer preferences. So no, the sky is not necessarily falling, and much of these sell-offs appear to be overdone. As a matter of fact, this may be a huge opportunity, an opportunity to dollar cost average by incrementally buying more shares of quality companies, collect the dividend, ride out the storm, and profit big in the long run. So yes, I plan on buying more, much more in coming weeks. With that in mind, I leave you with another quote. Be fearful when others are greedy, and be greedy when others are fearful.